Hey, Brian K., welcome. Welcome everybody. This is the Thursday night Viper Trading webinar. If you are here to learn about trading the futures markets, you are absolutely in the right place. First, we got to knock our standard disclaimer out of the way, so let's take care of that right now. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risks, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, so as I mentioned before we got started here, that we have a couple of things to cover. Our primary topic is detailed trade entries. Let's get over to a NASDAQ chart and get this thing kicked off here. Screen one. Let me square this puppy up real quick for you. So what I was talking about, some of you are just coming in, so don't worry, I'm just getting started here. And just for the sake of simplicity, most of you know, by the way, here again, if you're brand new with us or you're visiting us this week, welcome. We appreciate you joining the team and coming to check us out. And we're going to try to cover some good topics here tonight about detailed trade entries. I'm going to take, for simplicity's sake, just for now, I'll take the predictor off. Now, I'm going to start it this way. What is the one or two things that we need to do to do in the morning to prepare ourselves for trading that day? All right, let's do it on the NASI chart. Let's do it on the NASI chart here. Okay, all right, so here we're coming up to 6:30. Right here is the open of the market. Yeah, so here's the pre-market session right here. So what do? Everybody should know this, okay? This is the most important thing. When you get up, whatever time zone you're in, and you're getting ready to trade futures, and it doesn't matter what instrument you're going to trade. It could be gold. It doesn't matter, okay? You got to draw those lines. Please, 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 the number one thing that if you take anything away from this webinar tonight, it's this number one important thing. Draw lines on the charts. It can be as simple as this. It takes you like a minute to do it, really. All right, so you can see in the pre-market session here, we can put support and resistance lines right on the chart here. It just takes no time at all. There's one right there. Okay, now, you know, for you veterans that have heard me say this a million times, probably at least 1,000 times, you know, over the years, you don't have to spend, you know, you don't have to go so precise that you put, it has to be exactly precisely right at the exact perfect swing, because you just want to sort of get a preponderance of where the swings are located. Okay, so looking back here, you want this one a little bit above it. This was kind of right on it, these two right here. This one didn't quite get there, right? These two, these three right here. This one over here poked its head a little bit above it. You just want to kind of get it close, because all you're trying to do, and at the risk of sounding like repeating myself over and over again, support and resistance in reality is an area, right? It's an area where the market tends to go up to and it pulls back. That's resistance, right? Down here, for instance, we have support. I'd say generally somewhere kind of in this area right here. Here again, healthy way to think about support is somewhere in this area, generally speaking, the market has a tendency to come down to it and bounce. And on some occasions, it will come up and it will hit the top resistance area, which we've identified with that line right there. All right, so we're partially done with our first sort of chore of the morning, if you will, getting ready to trade. And I would go so far as to put another swing line sort of down in this area down here. You know, generally speaking, sort of down in there. Now, in keeping with this concept, before we can even look for trade entries, we have to say this to ourselves. You can say it in the pre-market session. You can say it throughout the course of the morning at the open. This is what we are going to, eventually you will internalize this and you won't have to say it to yourself. In the beginning, you might have to sort of physically say it to yourself to remind yourself. But going forward, once you've done it 100 times, you won't have to do it anymore. As long as this market remains confined between this line, and this line, we are said to be what in the NASDAQ market? I'll give you 10 seconds. This market remains between these two lines or between these two lines, this market is said to be what? There's only 2 or 3 possibilities it could be, so it's a pretty simple answer. I think 10 or 12 seconds is more than enough time to type in a word. Some of you made it into 2 words. It is range bound, sideways. Good, perfect. So, the characteristics of a sideways market, aside from the fact that you have these lines and it's bouncing between them, that's the obvious, pretty simple part about it is. But visually, if you look at the background, it takes on a striped kind of colors, plural. See how it's green and then red and then a neutral color, and it looks like a striped shirt, right? The other thing you're going to notice is it tends to go a little bit above the mid-band. You get some blue bars up here, hovers around the mid-band, you get a whole bunch of yellow bars here, and then it sort of goes down to support and you get some red bars down here. So you're in a range. You're in ranges. These are ranges, okay? Now, how many of you like to trade ranges? How many of you don't like to trade ranges? Yes, you do. Type in a Y or yes, you do, or an N or no, you don't. Really simple question. Do you like trading ranges or don't you like trading? If you don't like trading, type in an N, a no, I don't like it. Y for yes. Yes or no? Ooh, good mix from the team tonight. What do you think? Just try to participate in these webinars. The more you get into it and participate, the more you're going to learn, the more it's going to stick with you. Get chopped up all the time. So if I was to count the yeses versus the nos, out of all the people in here, the yeses are only 1. Justin, Peter, Pervez, so there's 3. Jay, 4. David, 5. Ooh, Diane, I love ranges. Yeah, that's right, Diane. You're the range queen. We'll give you that one. I'm new and still learning. Hey, Mario. I hate ranges. All right, so here's the deal. Look, at some point, I understand that most of you hate trading ranges. A lot of traders can't trade ranges, so don't feel bad about it. But I have to tell you something, that in today's markets, if you can't work some kind of range trading into your repertoire of entries and trades, you're going to be killing yourself a little bit, okay? Because as you probably know, markets are range bound from anywhere from 40, 50, as much as 60, even 70% sometimes. They'll just chop sideways. And you can sit on your hands and waste an entire day or a whole session or morning and not take any trades, when in fact there were trades to take. So what I'm going to suggest for those of you that don't like ranges is try to do this. And ranges are not all created equal. We're going to look at different markets and we're going to look at their ranges. NASDAQ is notorious for going a little further than you might expect it to, right? Now, how does that hurt? How does that hurt you? Here, let's take one of these, for instance. Let's just use an example. Let's suppose that you saw this area. This is in the pre-market, so I'm just going to use this as an example. I mean, this is a good example, and this is probably why some of you get freaked out about taking trades within the range, is because you're afraid you're going to get stopped out, right? I mean, isn't that the fear, really? That you're going to get in at a support level, it's not going to hold, it's going to stop you out, and you just get chopped up and get a whole bunch of losses. Yeah, I know, I have that fear. Everybody has that fear, right? Okay, and here's a good example, and NASDAQ is notorious for this. You might have been noticing that this was a support area, and you had maybe your line right here. So when NASDAQ came and it sat right here like this, you might have gotten long, right? Thinking it's going to bounce. and maybe you had a tight stop, and this might be an example where it bips you out, right? You get stopped out. Okay, so I'm going to say a couple of things in regards to this topic, this very topic right here, okay? And it's going to be this. It's really important what instrument you pick to do range-bound trading. NASDAQ is a real challenging one. Let's advance the chart and look some more. Here's a couple of more good examples. And this happened right before the open. Here's the open. Here's a good example right here. Let's look at NASDAQ was in this, I'll just advance it. NASDAQ was in this range all day long until about 9 o'clock. Let me ask you another question before we look at some more trades. When you're in a range like this, or ranges in this case, Nazi's not my friend. Well, okay, we'll look at other markets. We'll see some other things. When you're in a range, is a range a good idea to take mid-band trades like this? When you're in a range and the mid-band is in the middle of it, is this the time you should be taking these mid-band box trades? No. No, 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 no. Look, this whole thing top to bottom is 47.92 to say, maybe 25, 30 ticks, plus or minus, depending on where you actually put your lines. And the mid band is right in the middle. So it's about 15, 10, 12, 15 ticks up from here and here. What we're saying is this, generally speaking, when you have a tight range, 20 or 30 ticks and the mid band's in the middle, there's no meat here. Okay, there's no meat. There's just no meat here. By the time you get filled on a bar, you're almost right at support. You're trying to get some money down here, and before you try to get out of it, it's back in your face. So you don't want to take, so today, for instance, today when NASDAQ was doing this at 645, that right there, I stood down. Most of you probably remember I stood down in there. I said it's in a range with support down there around 86 and resistance up around 94, remember? Pick your poison if you want to trade that range. I said something to that effect, if anybody was in the room and remembers that. It's because I don't see good mid-band trades here. You're stuck in between the middle of a range that's with resistance up here and support down here. What do you do with this? What do you do with that right there? I mean, I suppose you could see this support and you could try to buy that and get out up here. I mean, there were some scalping things in here. But when you get in a very, very tight range or something like this, let me show you some examples of ranges that are just purely not tradable. Okay, you should really stand down like that right there. I mean, that was just a pure shotgun coming out of the open. You're 2-3 minutes into the open and it was shotgunning around, and NASDAQ has a tendency. Why is it doing that? Why do you get these shotguns like this? Anybody know? Why do markets do that? Why does it all of a sudden start shotgunning like that? Anybody have any idea? Why do markets do that? Why are they shotgunning all over the place? Especially right at the open or around news events. Just a ton of bars just flying in out of nowhere. Algorithms. They're scripts. Most of the trading done in these markets is by computers. Everybody knows that, right? It's all software. All the big banks and a lot of traders all over the world have algos, and they're all running, and right at the open, those algos are fighting each other for control of the market. So they're firing buy orders, they're firing sell orders, and they're all conflicting. You got pin-up orders in the pre-market session that are getting filled, that have been sitting there. Yeah, robots, computers, algos. So when you hear in the room somebody says something to the effect of those algos are really pumping today, the translation of that is the market is shooting around too fast for you to humanly trade, and you probably don't want to get in the middle of it. Okay, that's what that means. You know, when they're shooting up and down and all over the place and the direction is not clear, these are ranges you really should try to avoid. Because what they're going to do is they're going to chop you up, they're going to leave you all battered and beat up and bloody by the time they decide which way they're going to go, and then you wind up missing the big runs. Look at this. This is a mess. All right. I mean, you still could have tried to trade this. I mean, you could have been trying to buy support down here, right? You could have been shorting this up here. Every time it came up here, it rolled over pretty nicely. So if you're going to trade the range, it's really a subjective thing. It's partially part of your skill set, whether you can see the range and then decide, pick your spots, whether you're going to short the top or buy the bottom or trade both. You have to decide your entry technique. What kind of tools are you going to use? Are you going to use market orders? Are you going to box it in with the OT box? Are you going to use some other tools like the line or the ray trader? Hey, listen, I'll tell you what, and this is not no slighting of anybody here. If you try to trade these ranges and you just can't do it, well then you know what? Range trading might not be for you. And there's no problem standing down. Absolutely none at all. You say, look, Charles, I gave this a shot. But in all fairness to yourself, you have to give yourself a little time to try some different instruments. Try YM. Try NASI. Try the Russell. Try gold. Look at how the ranges are. Look at how the support works. You know, is it respecting the support with clean lines? And is there enough room? It's got to be at least 20 to 25 ticks. If it's less than 20 ticks, it's really a range you want to stay out of. Now I want to show you what happens here. All right, we're getting long in the tooth. Here, right about in here is when we close the room. You know, right here we're wrapping things up. We're closing the room, and you know, you had a support bounce here. It paused at the mid band. I'm trying to remember whether I took this long or not. I can't remember whether I was in this thing or not. Pulls back. What starts to happen over here? What's happening right over here? Right like within a couple of minutes of closing the room, what happens right here? Are we still range bound? Is Nasdaq still range bound now? Over here, 801, 802, 806, 810. What do you think? Still range bound? Are we still in the confines of this area? No, you're right. Yeah, everybody's typing it in. They've gone into an uptrend. You've broken out. It's broken through resistance. Now look, I'm going to show you a couple of really cool things that are so simple that can portend to you what is going to happen. Over here, you can see that with some amount of force, we break the top right in here. Now, in and of that break is not the significant part. Most people put too much accreditation to the fact that the top was broken. That's not the important part. It's important to note when that happens. What's the most important part to notice? What are the one or two things that's important things for you to notice when it comes to determining which direction it's going to break out and when it's doing it? In other words, take a look at the chart. Take a look at the chart right in here. Okay, I'm going to give you some hints. Look at the chart right over in here. What's happening over here? And how do we perk up our spidey sense when we're trading, our trading spidey sense, and say to ourselves, this looks like this is happening? Because that's how you get some insight as to what you're going to do next. You have to be like a little, how would you say, sort of like investigator, like a trade investigator, okay? You're constantly looking at assessing the situation and running some scenarios through your head. Well, you know, if it does this, it might do that. If it does this, then I'm going to do that. Yeah, you got a higher low. Good. So what am I saying here? I'm saying that when the market pulled back into here, oh, come on. There we go. It did what? What did it do right in here, right under the midband? Consolidated and bounced And after it bounced, it did what? Went up to here. And then what? Back. So it is giving you a series of, right, most of you have typed it in, higher highs and higher lows. It's giving you higher highs and higher lows. So just to help you out, when I'm looking at markets, I'm constantly scanning. My eyes are looking back from right to left, constantly, right to left, right to left. And I'm looking at these swings. I'm noticing, it broke that. Well, let's see where she pulls back to. Okay, whoa, now we're getting a little bit higher. It held the mid-band. Is this a long trade? Yeah. Now, are you going to catch the early ones? Maybe not. It pulls back in here and it holds this higher level of the prior support resistance level. Now becomes what? Support. Was that a long trade? Yes. Now, market runs all the way to here. Stick with me now on this, okay? Market goes all the way. By the time that this swing is taken out, there is no question you have a trend change. No question. You've already had 1, 2, 3, 4 higher swings. See them? Uptrend confirmed. Now, if you didn't catch this mid-band box and you didn't catch a box here and you're left holding the bag and the market runs all the way up to here, then what do you got to do? You got to jump in right here and hit a market order, right? I think a good fill would be right up in here. Who wants to take that with me? Let's open this up and hit market order. Live money, real account. Load it for bear, 20 contracts, no stops. Anybody with me? I mean, because we're all about buying the thrust, right? That's what we teach all the time. Years we've been teaching that. You buy the thrust move, right? Market thrusts, comes all the way up here. You watched all this happen. It's 8:20. You're still trading. The room's closed. You're watching NASDAQ. By the time it gets up here, you're convinced, man, this thing is on a tear. It's going to take me to the moon. I better get in. And you pull the trigger, boom, market order. No, 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 no. All right, in order of importance, the things we are going to remember from this webinar are, we draw our lines first thing in the morning so we know support and resistance. If we stay in the confines of the lines, we are range bound, and we decide if we're going to trade the range, shorting the top, buying the bottom. That's range bound trading. If at some point throughout the course of the day, the market breaks one direction or another, in this case it was up, we have confirmation of an uptrend. We've taken out swings. We have a series of higher highs and higher lows. Background is green. Predominant color of the bars is blue. The mid-band is stair-stepping up and has changed colors, like such. And most of you have heard this hundreds, scores of times, is that we are absolutely not thrust buyers and sellers. When a market is thrusting in a trend direction, and we're not in it, if you're in it, you're taking profits up here and trailing your stop, right? If you're in it from lower levels. But if you're not in it, you have to wait for a pullback. Now, when this market got all the way up here to 810 and a quarter, and we are thinking about a trade entry, everybody, by the way, total kudos and credits to everybody in here tonight. Everybody said, no, no, no. You've got to wait for a pullback. There's got to be some kind of retracement for you to get in. David E. said, go ahead and trade your money. You're not going to trade mine. That's pretty cool. All right, so this is the visualization part of taking the trade. We've seen all this activity. We're convinced the market is heading up, and we're looking for a retracement. So we're planning ahead a little bit here, right? We're not just going to sort of react to the market. We're going to plan ahead and try to anticipate what it might do. If this market was to pull back, where might it pull back to? By the way, I'm kicking myself. I was going to put this up for you guys and gals in here. After we go through this little exercise, I'm going to pull up the gold chart. Gold just had 2 beautiful textbook shorts, 3 of them actually in the last 20 minutes. Gold is moving, and it's going down. Yeah, good. Yeah, I've gone over this so many times in other webinars. Most of you probably know it by heart. We think of retracement as an area, okay? Retracements can be shallow. They can hit the mid-band. We like that, yes. And they could go a little deeper. Those are known as deep probe type trades, depending on how far down they go, right? Phantom trades, those kinds of things, right? I know most traders don't like the deep ones. I understand that. It's just like range mount trading. You have your ways. I understand. Good. All right, so now the market, we thrust up, we're thrusting up, we're pulling back, and where are those bars? Right there. 1, 2, 3. What are they? Let me give you a little hint. Where are they located? Where are those bars at? Right there. They're in the sweet spot of your retracement. In fact, this one wicked the midband. I mean, I don't think it gets any better than that. Isn't that just handing money to you? It respects the midband and comes right into the middle of the sweet spot of the retracement zone. For me, just truth be told, between us traders here, this is my favorite trade of all the trade types that we have. I love this trade. I trade it all the time, all the time, all the time, all the time. I put a object trader box around it, right? In this case, the trend is up, so it's biased to the long side. We don't want to take shorts. The reason we don't take shorts on entries like that is it's quite possible that we might sit here and then you get a little head fake down, bips you and fills you short, and next thing you know, bam, it takes off right in your face. You don't want to do that. When the trend is up, you're pretty much going to want to take long trades only. Now, let's talk about entry techniques and entry types. In the room, you're going to hear Gary say a lot, I'm turning my bar close on. What does that mean? What's he talking about? I'm turning my bar close on Object Trader. What the heck's he talking about? I'm turning my bar close on. What is that? Anybody know? Everybody should know this. You should be typing in an answer right now and know exactly what that is. And if you don't, I strongly urge you to go to his webinars or download those recordings, because that's one of the better entry techniques built right into Object Trader. I'm turning bar close on. What does that mean? What is he doing? Okay, yeah, it's a trade type. So when a market enters into the sweet spot of your entry area, which is right down in here near the midband, you activate bar close, and when a bar closes up, it's a type of entry. It's a bar type of entry, right? And depending on when you turned it on, you would have been filled long on one of two bars, possibly on this one, but definitely on this one, you would be in. Okay? I strongly urge all of you, especially if you're new to Object Trader and new to our trade group here, Viper team, experiment with that. Take the instrument that you like to trade on. Take all the tools and play with them and find out which ones you like the best. I'm partial to the box. I would have been in on that bar too. See how it closed up outside the box? I'd be long right here, the same as the bar close guy, trader. All right, look, I got to drag this over. This is just too much to bear. Let me share something with you real quick. I should have pulled this over earlier. My apologies to everybody. Look at these textbook gold trades. Oh, just handing you money tonight. Everybody see these? Where are the 3 trade entries on this chart? I'll give you 20 seconds. You can type in a time. The time is down here. A time where you see them, or a level, like, you know, like a price level. Where's the 3 gold shorts? Tell you what, I'll give you 30 seconds. 30 seconds for the gold shorts. Where are they? I know 30 seconds was tight, so I'll give you a little bit more time. Sorry about that. I know that was tight. Ooh, some good levels. Mindy, David, Chris, those look good. Peter, Michael. Dennis just typed in 6. Oh no, that's the end of your other one. 12, 16. Okay, I got it. I was looking at it like, oh, he just typed in a 6. That's a good trade entry. Mario coming in. Michelle, Tom, Pervez, I like those numbers. Good. Hey, listen, this is another thing you can do. Look, if you have some spare time, go back and look at some charts. D coming in, those numbers look really good, D. Greg. Go back and look at some charts. Just look at it. It doesn't matter what charts you look at. Look at any chart. You should be able to instantly see where the trade setups are. I mean, you shouldn't even have to. I've done it so much. It's just like in my subconscious. I don't even have to think about it really anymore too much. It's just I sort of see them. Maybe it's 10,000 hours of chart time in 20 years. Maybe that's got something to do with it. But look at what gold did. Every time it got up here near the mid band, it rolled over, right? Look at this. This is the retracements we're talking about. Let me just show you real quick. And all the numbers I see, everybody sees these, right? Here's your thrust. And here's your retracement. Textbook. Just textbook mid-band trade. Right up to it, it hits it, 1490, and right back down. Yeah. So if you said anywhere around here for your first one, 1490-ish, which occurred about 1629, that's 4:30 my time, roughly. Textbook roll. And then look here, but within 2 ticks, we get another retracement right back up to the mid band. Right? Hits it, 15, 15, 10, rolls over. There's your entry right there. Bar close, line tool, ray tool. You said anywhere around 1510, 1490, 15, around 1653, which would have been almost 5 o'clock Pacific, my time. That was short number 2. Short number 1 was right here. You can use the box or the bar close or the ray or the any tool that you like. Market order. However you get in, you get on that rollover. Yes. Getting better at seeing those, David? Yeah, it takes a little time. No problem. And then here's the third one right here. It just happened. Like 15 minutes into here, I was watching this chart. I wanted to drag it down, but it happened pretty quick. Okay, gold comes right back to the mid-band. Bar close, box, ray, tool, market order. By hook or by crook, you're short again right there, right? No long trades in here. Shorts only. So, 17, 20, 23, 25, you said anywhere time-wise, and 12, 13, 60, 50. Textbook, 3 mid-band rolls. Now, look, here I want to show you something else. Yeah, they were predictor trade too. Yeah, predictor is really good for that. I love the predictor. Look how it's showing where all these swings are. It's beautiful. Just textbook. Predictor sitting right on the mid-band. Beautiful, huh? Now, when I was talking about, and this really has a lot to do with the strength of the move, okay? And here's what I'm talking about when we talk about the sweet spot of taking a rollover trade, all right? When we talk about shallow retracements, there are many, many times where a market won't come back to the mid-band. Okay, it'll get a little bit of short covering. In this case, a little bit of short covering. You reach an equilibrium, you roll over, the shorties come right back in. Sometimes it only gets, in this case, to line 2 or the stealth line. See how it's just checking line 2? Here it comes within, looks to be about 5 ticks in the mid-band. You get another roll. There's another short entry. Now, for the trader who got in up here, this could be one continuous trade. If you'd caught this roll, you could be still in it and trailing a stop. But if you aren't, you can't, you don't want to get in right now. I don't usually use the touch, Tom. It's got usually I want to see a close. I want to see a close outside the box, either up or down, to get in the trade. That's normal. All right, so let's do something for fun while we're all in here together. If gold was to retrace, where might it go to for us to get short? Let's make sure I'm in sim here. Hold on. Yeah, sim. Okay. In fact, I'll put the orders right on the chart. You tell me where to put the orders. Where do you want to short this thing? I'll put 3 cells on here. How about there? How about here? And you want something in the middle? You want to go lower? Like that? You want to go down by line 2 or stealth? Lower? Predictor? 07 to 06? Okay, I'm at 6.9, 07. It's right at 06. What are you saying, Tom, Chris, Brian? Short it right now? Stealth and midband. Okay. All right. Let me put some orders on here just to have something to watch while we're doing this here. All right, we're filled 1. See if it goes any higher. I see all your numbers, by the way. I appreciate you putting all those numbers in. Tom, Chris, Brian, Jay, and Joe all put in numbers. Tom says retracement to 08, 06, midband to Phantom, 09 from Joe K. Yeah, see, this is what I was trying to say. This is what you're going to see. So in terms of retracements, I think everybody can see clearly on this live gold chart. I'm not trading live money, but it is live data. This is what gold's actually doing right now. You get a shallow retracement where it only comes up into here. You can get a nice midband retracement where it comes up to check the midband. Everybody likes those. I know that. It can go more shallow. Now, this would be a good candidate. I unfortunately don't have OT on here, but for your Ray tool. If you're looking for an alternative to the bar close or the box, we're boxing in the room all the time, so you're used to hearing and doing boxes, right? You know, the box it in near the midband. There's a nice box setting up right there just under the midband. We all know what that means, right? We're talking about taking an object trader box, enclosing the candles in that area where it's sitting, and then either you let it trade both sides or you take the long or the short, right? Now, if you use the line or the Ray tool, in other words, when it closes below it, you would be filled short. You want to make sure that you don't make it too tight, okay? You want to have it should generally be pretty close to about a 45-degree angle, and you want to kind of follow the tips of the bottoms of the candles as they sort of ABC up here, right? Everybody see that? I love the Ray tool. Brian loves it. Hey, listen, the reason we built all these tools over the years is for everybody to use them. We use them. Gary and I use them. Gary and I trade for a living. You know, we started this business, 7, 8 plus, almost going on 9 years now, I think. And we actually built the tools for us to trade. We were traders. Excuse me. And we had some friends who traded too. And then most of you know the story, of course. And then we had the friends we got kind of a loose collection of people that we got together in a little, I guess it wasn't really kind of a live room. Anyway, we were all sort of trading together. And then a couple of them said, hey, if you share these tools with us, we'd pay you for them. And that's the seed of how Viper was born. Next thing you know, we started licensing the tools, and we got full on with Ninja and live room, and off it went. But no, what I'm trying to say, the whole point of trying to say the story, we built the tools out of necessity for us to use to trade them, because we were trading for a living before Viper came along, and then we decided to share the tools with everybody else, and that's why we're at here. But what I'm trying to say here is that you should take advantage of everything that we have to offer, not only just the indicators, but all the components of Object Trader and all the entry tools that we have. All right, so it didn't quite get back here. If you look, we got filled on this short here. So it came in between line 2, the stealth, and the midband, and it's looking like we're going to get a roll here. Depending on where you drew the line, you'd be filled short too. Now, notice how I'm not putting in targets and stops just yet. Okay? I'm not putting targets and stops in yet because it hasn't moved much in our favor. Ideally, what you want to do, if you can get and I've talked about risk management before. If you haven't looked at the risk management webinar, I think that was last Thursday night. Please take a look at it. It's very, very good. It's detailed about how many contracts you can take, you know, what instruments you should be looking at. If you can, download and watch last Thursday's webinar. I'm not going to get into that right now. But if you can, ideally what you want to do is you want to get 2 or 3 contracts on here, right? Because if this is going to bip up and roll, we want to be able to get to here for a scalp target where we peel one off. I'd like to see it get to here. So what I'm saying, just to be clear and not mince words and be very explicitly clear about this, is that I would like to see this one filled so I have 2 on, because I'd be peeling one of them right here. And I'd pull the stop down real tight on the second one. All right, might bip up and fill us. It's kind of dinking around here. It's stalling out a little bit here. Does everybody see what we're trying to do? Now, if I had OT up here and you're not in it, the ray tool would be filled, of course, also already. You could box it. Some of you might be patient. If you were going to box it, you'd want to do it something like this, bias to the downside. Some of you might want to be more patient, and if it gets up here, wait till it gets here and then box it. Some of you, I know you do because I've Skyped with you. Some of you wait for an ABC move and then you put your ray or your line in. For those of you who hesitated or do the box now, you would not be short. Everybody see that? Yeah, good box, bad box, John. We used to talk. Hey, basically what it boils down to is the size of the box. You generally don't want your box, getting back to this notion of good box, bad box that John typed in there. In fact, I've had whole webinars dedicated to this very topic. But the key is this. It can't be too big. If you get over, most of them need to be right around 8 ticks. 6, 8, 10 ticks, real tight consolidation of bars. See these bars right here? Let me show you. Let's go back to these shorts right here. Let me show you what I'm talking about. This is a good box right here in terms of boxing a short entry on this gold trade right here. See how tight this little box is when it formed? See how it just touched the mid-band right here perfectly, wicked it, and then sat here for, I don't know, here, let me see, 52. It sat here 2-3 minutes. I mean, it's not like it rolled 30 seconds off of here. I mean, you had 2 or 3 minutes to put a box around it. See that? But I want to share you the tightness of the box. Here you're looking at 1450 support and 15.1. So that's a 6-tick box, roughly 5-6 ticks. See how the candles are all sort of tightly packed and clustered together, sitting tightly at the resistance at the midband. This is an example of a good box, right? Right at resistance, and tightly packed. See, notice how this one's slightly larger. I mean, if you engulf the candle wick up here, it would be more like that. So you're looking at 12, 14 to yeah, so you're right at 8, 10 ticks here. See, this size box right here is kind of pushing the upper end. If this box had to be much bigger, like up into here, that would fall into the bad box territory, and I would hesitate to take that. In a nutshell, that's kind of the good box, bad box view of mainly the size and the location, of course. You want to watch this gold trade for a few minutes? What do you think? There you go. You're filled 2 now. What do we want to do on this little third entry here? Pull it down to the midband or leave it up here where it's at? It's a good box now. That's what I was just saying, Pervez. You're going to fill us on that third one up there. Yep. There you go. Pervez was right on the money. There you go. For you patient traders, you could be sure to get put in your box right there. You ray traders, your ray would be extending up here. That's the advantage of having the ray versus the line. The line, you have to keep moving it around, right? Because it's a finite tool. It doesn't extend out into the future, where the ray when you take a swing and you connect it to another swing and it projects out into the future, the ray would just continue on like this. Now let me explain the advantage of doing that, okay? Of you starting to I know some of you use the ray, okay? This is for those of you who aren't using the ray tool in Object Trader. Is that, let's say hypothetically, gold just continues to do this, the ABC. So what I'm saying is this, okay? So here's your A of the ABC. Here's your B, right? We all see it. Here's your C. And you're right in the middle of kind of getting a D. Now, what could happen is that it could continue. You could get, you know, hypothetically, you could get E and F before it eventually rolls, and then eventually, perhaps, you know, it's all hypothetical. It's set into the future. You know, at some point it would break, would roll and break. You know, and you get filled on the ray. Everybody see that? That's the use of that tool. That's how that tool would use. A, B, C, D, E, F, G, as long as you continue. And then at some point, if it gets all the way up to the phantom and breaks it and you get a trend change, then of course you would turn off the ray. There's at some point here where the ray would just continue to not prove to be a useful tool, right? Now you hear the term, just real quick, I'm not going to cover these. I'm going to save these trades for Saturday morning. Another trade type you hear quite a bit in the live room is the phantom trade. Okay, the phantom is just a word for the outermost band, generally speaking. Okay, if you're wondering what the heck are they talking about, a phantom trade, what a phantom was, or some ghost flying around in here? No, the phantom trade is referring to the outermost band. In the case of a downtrend, when a market comes all the way back up here to the outermost band in a downtrend and rolls over and breaks down, that's considered a phantom trade short. Now I know that freaks a lot of people out, okay? I understand that. I hear this all the time from traders. I hear it all the time. Okay, it's moving in our favor. Let's get some targets and stops in here. Okay, how many want you peel here at 06? We want to buy one back? And then for the second one, how many of you want it on 06 or higher? Just type in on 06 or higher. 06, just type in 6. If you want me to put it right on 06. Right here where I had that line. Remember I said, what did I say? If I have 2 on, I'm going to peel one at 06. Remember I put that line there like 5 minutes ago, remember? 06, we're getting some votes in here. All right, I'll leave it there. We'll see if it gets filled. It's coming right to it. It's going to fill it in 1 second. Watch. Watch. Boom. Take it out. All right, now for the runner, there, we're off. It's off. Just filled it. You just banked 120 bucks. All right, now for the runner here, how many of you want to fade the bottom? Okay, I'm going to give you several buy to covers down here. Or you want it to buy it back and let it run. Fading the bottom. Whoa, get it out of the way. It's going to get it. Whoa, it's shotgunning. Shotgun a little bit on us. Don't panic. All right, hold on. There's some news coming in here. All right, I'm going to leave it loose for now. All right, let's get our stops in. Where do we want our stops? You're going to buy it back. How many of you want it right on the entry? Or you want to go under it by a tick? How you like that? You like that? Boom. Done. There you go. Now, why did I put, okay, follow up here. Why did I put the stop 3 ticks under the entry? Why did I just do that? Why did I let it take it out like that? Anybody know? While you're pondering that, let's circle back and recap what happened here. Okay, we had a short, we had a sell short up in here. We got filled. The first one, I think it was somewhere in here. We had the second one up in here, and we had a blended average. I think it was somewhere right in here. on two lot. If you had boxed it in up here, you would have been filled almost roughly at the same place. If you used the ray tool, you probably got in on the close of that bar. So all the entries turned out to be pretty close to be the same. That's the free trade. That's right. That's the free trade. Lock in the profits. That's right. So let's reconstruct real quick, and then we'll move on. You see it was ABC and up, right? It was ABC. Now that might have turned out to be a little too tight. What I probably should have done was gone on or one tick behind the entry. Since we already popped and got filled for that 12 tick pop there, you could have safely gone a tick above it, which you would still be in this trade. Okay, but locking it in was guaranteeing that we locked in the 12 ticks, and we got an extra 3 ticks when it popped us out right there. So sometimes you don't want to do that, all right? Look, if you got a nice run in market, you can go a tick or two above their entry, and you'll still net 10, 11 ticks, right? If you think it's going to bip back up through here real fast, and and you don't want to deal with the retracement and trying to get in again and losing money off your scalper, well then yeah, crank it down here, and the wick of that candle took it. But it's a good thing we came right on that 06. Everybody said for that scalp that 06, and we dragged it right up and it filled. And the way it started shotgunning, remember I had a runner? If you'd faded this, it's quite possible that the fade might have got it too. I dragged it out of the way, remember? Remember I had a fade, I had another one sitting right here, pretty close to it. But then I dragged it out of the way. So these are the options. These are what you have to decide. When you're looking at a market like this, it doesn't matter. This is gold after hours. Okay, it doesn't matter what it is. It could be anything. But this is the assessment that you do. You clearly see where you wanted to get in. It came right to it. Whatever tool you used to get in here, it was another. That was your 4th mid-band roll short. Just textbook, right? We got the scalper trade right to here at 06. And then you have to manage your stops, right, on whatever you have left on. You can either go on the entry, a tick or 2 behind it, or you can give yourself a free trade, which means that you're inside of your entry on the short, meaning that you're not going to lose any money. No matter what this market does with your final stop located here and your entry here, no matter what it does, you make money. That's called a free trade. All right, good deal. We're right here at 6 o'clock. I think I'm going to wrap. I got some family here. So any questions? I was glad we were able to come in and take a little gold trade here. That worked out pretty well. Any final questions on what we covered here tonight? I know I didn't cover everything I wanted to. My apologies. We'll pick all the rest of it up again on Saturday morning. I see some of you had come in late, and I know a couple of you had to, let me turn the recorder off here.